Oh, I see on the bottom it says you're in the show. I thought that when we were live.
Well, we are live now. So,
Okay.
hey, everybody, welcome to the Victor H Investing channel. This is the live stream where we're going to look at the stock market. We're going to talk about some individual stocks. We're going to talk about some topics that we had in mind. I don't think he needs much of an introduction. Scott, with Scott's due diligence is on. Thanks so much, Scott, for joining me.
Yeah, definitely. Anytime. Yeah. So how did you meet? I had Costa on a live stream, 2 live streams on my channel before. Did you see him through my channel, like my live stream, or you just met him through like the YouTube universe?
So I had seen his videos prior to him being on with you. And when I thought, hey, I'd like to add some conversations like the one you and I are having, I reached out to him and he was generous enough to agree to get on.
Yeah, no, he's really good. He's smart. I feel like he understands things. Some things are on a deeper level, like more like I don't know how to explain it. Like, yeah, I guess we all have our own like specialties.
Yeah, I think he's from a intellectual perspective, he's like a big topic, educated perspective, and I appreciate that. I think that helps me kind of like establish broader vision of the market and kind of remember some of these principles that really do matter. Like some of these principles of investing matter, like valuations. Valuations matter to me. They may not matter to every investor, but they matter to me. And I like how Costa covers things. So let me cover something off before we jump in. So everybody, this is Victor with Victor H Investing. And just a reminder, I'm an individual value investor, and I'm going to speak for both of us in saying that any stock we cover, we're not recommending you buy the stock. We're not recommending you sell the stock. We're not recommending you buy options on any of the stocks we cover. We're not recommending you short any stock that we're covering. We're sharing opinions and we're sharing our journeys as investors, and that's all we're doing. And none of this is financial advice. Just keep that in mind. And of course, investing decisions are important, so please weigh them very, very carefully. So with that in mind, look, we already got a comment here. Cinematographers. Great to see you, man. I really appreciate you're a regular. Hi, Scott, Victor. We take a look at VST, Vista Corp. I have looked at this one in the past, maybe 2 years ago. So it'd be great to take a look at Vista. A little bit later, we want to have a quick conversation around the stock market and maybe some trends we're seeing. Bring up a couple of topics we had in mind, but we'll blend in any stocks you guys want to look at. Please suggest them as early as you can. I commit to covering them. What I do commit is one stock symbol per comment. So just if somebody has a comment with like 4 stock symbols, I'm going to take the first one and go through the others. That way I don't have people holding, because I've run out of time on live streams and I hate doing that to people. And then I'll come back to your comment and maybe cover the second one on your comment. If you want to cover multiple stocks, do multiple comments, maybe one early, one middle, one late. All right. So let me catch up on comments and then we'll get started. So Brian Wall, I think it's the first time that you are commenting. Really appreciate you joining. Hey guys, this is legendary. Thanks for all you do. Hey, yeah, Scott, thanks for everything you do, man. For 4 years, I've been benefiting from your channel. And thank you, Brian, and everybody for joining. I have a lot of fun doing this, and I really appreciate you putting the comment out there.
Byron, hey, what's up? Yeah, I recognize that name.
Yeah, cool. So, yeah, I'm a big fan of Scott and appreciate his channel. All right, cool. Just got Meta. Thoughts on Meta long term? Be happy to. You're talking to 2 Meta, I think, long term investors.
Yeah, you don't get much bullish here on Meta.
So, and I have comments. I think I've got a lot to share there, and I'm going to give the floor first to Scott on Meta when we get there. But I think you've come to the right live stream to talk about Meta. if you ever want to talk about Meta, Alphabet, Chevron, Uber, there's some stocks that I like. I can roll out of bed and talk about for 45 minutes, but I'm not going to bore you guys with 45 minutes of talk. All right. Cool. So let's get started. So Scott, it was an interesting week. Let me share a quick screen here. So it was a 4-day trading week. Hopefully you had a really nice Memorial Day. And we had 4 days. And for the most part, we were negative. We were negative Wednesday, Thursday. And then Friday, we were negative most of the day. We had this late afternoon rally, which was super interesting. And the Dow really rallied Friday. And the Russell's kind of rallying. The Russell was in the positive for the last 5 days. And the NASDAQ ended up negative. S&P ended up negative. So just your thoughts on what you thought of last week's trading. Is it telling you anything? Is it hinting anything to you?
Yeah, I think we're in like a it's a weird place because I think it took me like my portfolio has almost doubled in a year. So for 6 years, I've done equally as well as I did in the past 12 months. I guess that's mainly because I'm so heavy Meta, and Meta went up 4x. That's probably a big reason. But and I totally understand why people think it's gonna pull back or even crash. And I can't say either way what's gonna happen, of course, but I have no clue. But the fundamentals are there. It's not like I don't know if anybody remembers 2001 or was it even trading then. You might have been a kid or whatever, but yeah, that's when I kind of started, and the valuations were just crazy because the fundamentals weren't there and companies weren't making any money. All they had to do was put the word .com after their name and the stock went up 20x. So the fundamentals are there. You do find some stocks here and there where they're not really making much money, but those stocks fizzle out. These big companies like Nvidia, Meta, Amazon, Google, the numbers they're putting up are just amazing, especially Nvidia. Like they're really putting up good numbers. Like they're not just going up because of hype. There is definitely hype in there, of course. There's a little too much hype. It probably shouldn't be that high, but it's not like Tesla. Tesla wasn't that long ago, and they were trading at a 200 PE for a long time. Amazon was trading at a 100, 200 PE. Nvidia is like what, 40, 50, 60, maybe even in a forward PE might be better. So I don't know. I just don't. I don't see a downside. As much. I did see a downside in 2000, like 2013, 14, but it never went down, and I saw a downside but now it's just they're putting up great numbers. But yeah. But you're bearish Nvidia, so you see something a little different.
Let me go through. So first, as if anybody saw the video I put out there, I shorted Nvidia on Wednesday, and I'll get into that a little bit later. But just in respect to this company, I owned Nvidia for some time. I sold it. I haven't owned it for the last 2 years, and I think very highly of the company. There's nothing wrong with this company, but the company is not the stock price, and the stock price is not the company. They're two separate things, and the company is just fine, but the stock price is incredibly high. Having said that, I think that the semiconductor space is incredibly expensive, and I think people could argue with me on, maybe some of the fundamentals that maybe I don't get how fast it's going to grow. I don't get how AI is going to be the next industrial revolution. I'm willing to admit that I cannot forecast that. And if somebody else has a different viewpoint, That's cool. But I don't know if many people are going to argue with me with the fact that NVIDIA is expensive. I think most people would agree. Some people quickly justify why it's that expensive, but let's put that aside for a minute. What I've seen in the market and what I sense in this volatility we saw is fear. And the one thing, I get fearful when everybody's greedy. So when everybody's like, hey man, the party has been going on for a while and it is great. And I'm going to get myself in a better view here. So for a year and a half, it's been go, go. Okay. And we look at the end of 2022 in the S&P to now, we're up 47%. It's been a great period to own a stock. And congratulations, Scott. You know, Meta's rocking. We got Uber rocking. We got, you know, a bunch of stocks are just doing great. And at some point, the market gets expensive. And there's a lot of exuberance right here. There's a lot of greed. If you observe, especially the NVIDIA investors, they're like, man, it's going to keep going up because it's been going up. It's been going up because it can't go down. It's going up because they're going to just do all these brilliant, magnificent things. The AI space is not going to be built without setbacks. It's going to be 2 steps forward, 1 step back, 2 steps forward, half a step back. It's going to be 3 steps forward. So when it takes those steps backward, I think we're going to have these, you know, pullbacks, if not corrections. And that's my feeling about it. And I think that in the volatility that I observed for the last 5 days, you are seeing some of that fear. The smart money is not going to wait a whole long to get out of some of these semiconductor stocks. That would be like NVIDIA. You saw what happened to Dell, right? And Dell would be an interesting stock to really see if it's a canary in the gold mine. So Dell's down 18%. They beat on expectations, but they said 2 things. One, AI servers did not sell as much as everybody expected, and they didn't make any money. It's like, okay, great. You sold all that product, but you didn't make money. And their backlog was very weak. So this whole AI boom thing, where's the boom? Dell should be like, oh my God, we have this backlog for 5 years. There's no way we can keep up with it. So we're raising prices through the roof because, you know, people are going to pay it because they want to build the AI space so fast. Well, Dell actually said something to the contrary of that. So that's a signal. So those are signals to me that there's just too much exuberance there. Everybody believes that the AI space, or not everybody, a lot of investors believe that the AI space is going to be created. And I agree, in about 5 to 10 years, it's going to be somewhat like done. But for now, between now and then, we're going to have two steps forward, 1 step back. This is going to happen. The governments are going to enter the picture at some point and say, time out. You cannot release a new AI app that does this because it infringes on this right or this privacy or something. You know the government's going to come in. And when they do, how's that going to affect AI? What if AI is supposed to replace a bunch of jobs? Are government officials going to sit by and say, oh yeah, my constituents are going to vote for somebody else if I lose a bunch of jobs? So no, I'm going to stop it. And say, no, you can't put AI in these use cases because I'm going to protect jobs. All those things have to work themselves out, and they will. They will eventually, and this technology will do what it's supposed to do, but it's just going to take a lot longer. So having said that, a couple of trades that I did this week and a couple of trades that you did this week. I don't know if you want to talk about Etsy, but I wanted to give you the floor first.
Yeah, no, I'm happy to talk about Etsy. It's but I wanted to I want to talk about what we talked about before the call. Is the market due for a pullback? Let me share my screen. Can I share?
Okay.
So this is just from a fundamental explanation on why I don't think there'll be a pullback. And I understand why people think that, because they're just looking at numbers. And when you see something go up so much in price, you assume it's overvalued. And when you see something go down in price, you assume it's undervalued. But that's not always the case, of course, because you have to look at, not just the price something, just the value of it, and then combine those two. It's like $50 is pretty cheap for a car, but $50 is very expensive for a dozen eggs. So you have to compare the dollar amount to something, not just say $50 is expensive. So this is my theory on why it's not overvalued, because if you look at the market as a whole, and I think the best way to look at it is look at the P/E ratio for the S&P. And it's currently at 27, which is, a little high. But if you look at historically, and this goes back to 1800s, maybe it'll probably be better to look at this one. This only goes back, I think, to the 1930s.
Good. Yeah.
But you can see for 100 years, we traded sub 30 PE. And then it started in 2000, or probably like 98. It broke through 30. So I don't think we're going to be trading at like.
Well, let me ask you a question.
Yeah.
So this data is in the aggregate. This includes from an industrial company to a tech company, comm services, includes everything. But I've observed that much of the appreciation has happened really in technology and communication services. So those two sectors, I believe, are overpriced. And I think this generalized data doesn't show that. I think if you showed like industrial, healthcare, consumer staples, you would see that their prices are probably fine. Like, whoa, they're actually discounted. But when you average them together, you get this generalized data. What do you think of that perspective?
Well, no matter what time frame you look at, what year you look at, there will be many, many companies and possibly a few sectors that are way overvalued or way undervalued. I'm just talking about, will there be a market crash? And I just don't see it based on the data. That's all I was trying to convey. Yeah, I do agree that technology is dragging things up a bit and pushing it to.
And I don't believe, so let's define terms. So I believe a crash is like what we saw in 2022, right? The market went down 25%. Or no, actually, I wouldn't even call that a crash. A crash is COVID. You had COVID announced, stocks crashed in less than 3 months. You had like more than 30% loss. That's a crash. A correction is what we saw in 22, which is a slow downward slope because of various reasons. And then a pullback is like what we just saw here in April, which was a 5% pullback. It could be a 10% pullback. I believe that we can have pullbacks and a correction of like 10% in the next 7 months. I'm not expecting a correction, up to like 20% or anything. I'm just expecting we got to have a relief, period of some sectors giving up some gains, especially semiconductor and technology. You're seeing software companies give up a lot of gains. CRM, Salesforce had a bad week, and it really pulled down a bunch of other software companies. So you're seeing that fear. You're seeing that, hey, the smart investors, these are big investors, are making moves, and that's driving the market.
Yeah. So just my theory, I'm always on a long-term basis. And I think if you're hoarding cash, and I just think, and you're waiting for a correction, I think you're losing out. And I don't see it. I don't see a big correction coming. It's not that it's been, I think the new normal is a 25 PE. It's not like it was in the 50s and 60s and 30s and 40s, where the normal was like a probably average of 15 PE. But we could talk about Etsy. I just wanted to convey that point because I thought.
Great point.
So Etsy is probably not. it's definitely not my normal investment. I usually kind of keep it simple. I pick big companies that are established, and ideally I can get them at a good discount. But I'm not totally looking to trying to time the market. I did time Netflix in a sense, because when it was down 50%, because I wanted to buy Netflix for a long time. So, and I didn't. It's not like I timed it well. I'll show you why. I mean, I'm up 60% on my investment, but I wanted to own Netflix for a while. In 2012, I wanted to buy it because I loved it, getting those CDs in the mail, the red CDs. But I didn't, and then it ran up to almost 700, and I'm like, God damn! And then it went down 50%. So I sold out of something, because I generally don't keep cash on hand. So in order to buy something, I have to sell something. So when it was like a 350, I sold it, and I sold something, and I bought into Netflix, and then right away it was down 50%. So I'm like, okay, that didn't work out. But now it's doing fine. Now it's almost at its all-time high. So generally I don't like time the market. I like certain stocks, and I just keep buying more and more of it. I buy the S&P 500 a lot if I don't know what to buy. But yeah, Etsy is just a little different, and it's not based on their fundamentals, because I actually don't. I do the DCF videos, not because, I mean, I do use them personally, the DCF, but it's only maybe 10% of my investing decision. And I don't think you should make a decision on anything, on any one thing alone. It should be multiple things. I generally look at the company and try to understand it, of course, but think about the long-term prospects and like, does it make sense? And the reason I like them is just because they're so different and unique, and I don't think Amazon can take them over. Amazon could take over eBay theoretically, because they're so big and they do the same exact thing. But Etsy just has this specialized client base where they buy handmade stuff.
It's a little more like gig economy meets e-commerce, because you get a lot of personalized stuff. Like I think I mentioned yesterday in our live stream, we actually have a cousin, and she's really artistic, and she's doing really well on Etsy, because like she gets all these orders for birthdays and anniversaries, and she personalizes this stuff, and she makes like $600 to $1,000 per order, and maybe it takes her a day or two to create that order. But I mean, that's really good money, and both sides are really happy, and Amazon can't touch that. Amazon has no way to touch that.
Yeah. I mean, people say, why can't Amazon do the same thing? Why can't? Just because if you want to buy like a hamburger, you go to your local supermarket. But if you want to buy really high quality steak, you may go to a butcher shop. You may go to somebody specialized, and people like going to specialty places because that's all they sell, and people feel more comfortable, and they trust someone who only sells that product as opposed to someone who sells everything. Here's their stock, and this is, I have a hard time doing this myself, but try not to always just buy things that are trading at an all-time high. That's what most people do, is that when everybody's buying something and it's trading at its all-time high, like people are piling into NVIDIA. And I'm not saying, some people made a lot of money, so I feel kind of stupid for not buying in myself, but it's probably better to buy something when it's not at its all-time high. It's probably better to buy it when you could get it at a discount. The only way to do that is you have to buy it before everybody finds out about it, like over here. But if you miss the run up, you could still buy into it after the fact. Now, will it go down to zero? It could. But I see the downside limited.
Yeah.
Of course, everybody has downside, but I see it's kind of limited, where the upside, there's much more potential with them.
Yeah. Yeah. And another point to like yeah, if you buy it early, then you participate in the run up. But that means that you're good enough to know that, hey, Etsy back in, I don't know what year that is going to really go, or Nvidia is really going to go, or so and so. So I'm not that good. So I'd have to buy 3, maybe 4 companies, and maybe one works out. And then I have maybe 1 or 2 dogs, and maybe I have one that's okay. But, I've been fortunate with a couple. I mean, I just sold Panel and I did really well with it, but I bought TSM early and I did really well with it. But I also bought a bunch of dogs along the way where it's like, hey man, I took like a 30-40% loss on those.
Yeah. I mean, I have Abcelera, I'm down 50%, and Pet Med Express, because I mean, in my 20s, I was much more wild with investing. I would do options. I would put 90% of my money in one thing. Because I didn't have that much money to invest. It wasn't like, even into my early 30s, I didn't have that much of a bankroll. But as you get older and start accumulating, then you make better decisions. And you can't really like.
What's interesting. I had this conversation with my 19-year-old son yesterday, who we were talking about a couple of things, and he was like, so when I was 25, now looking back 30 years ago, well, that young investor should really invest in growth, right? Equities, growth, and so forth. But at 25, I was nowhere near the knowledge that I have at 55, the work experience. I mean, I've worked with a long list of different types of companies. I have just more capital. I have enough capital to take chances and not really affect my lifestyle or affect any of my family's lifestyle. So having said that, it's kind of like one of those oxymorons, where when you're young, you have time, but you don't have capital, and you don't have maybe experience, right? You might be smart, but you don't have experience, and you don't have confidence because you haven't invested a long time. And as you get older, now at 55, I'm actually in some ways investing with greater levels of risk as opposed to my 25-year-old self. Was it the right path? You know what? That's the path I took, and I'm glad I did it. I saved a lot early, but I invested based on like textbook recommendations. I would read books and say, that's what this investor that I believe in, Peter Lynch, Warren Buffett, that's how I'm going to invest. Now I'm like, they taught me really good principles, but I do it my way. I invested in real estate, which has been my biggest winner in 2010. Nobody wanted to touch real estate. Nobody. You could go to 20 properties, put a very good offer, like a lower price, terms that you liked, and they would take it. Within the same day, they would take it. Now it's like you go and there's 100 buyers and you have to like pay cash and all kinds of stuff. So having, that was a big risk that I took, however many, 14 years ago. It worked out nicely. Now at 55, I'm taking bigger risks because I have a part of my portfolio where I'm not planning to, but if I lost it all, it wouldn't affect my life. It wouldn't affect the inheritance to my kids. It wouldn't affect anything. So I'm playing with the house's money at this point.
Yeah, that's the way to do it.
So I wanted to catch up on comments once you're done with your train of thought. You good? Oh, we lost him. Let's see if he rejoins. While Scott is rejoining, let me catch up on some comments. So, all right. So, Blade, always heard semiconductors were cyclical stocks. Either semis are in a prolonged bull cycle. Hey, Scott, thanks for coming back.
I thought the button said stop sharing, but it said leave studio, and I hit it. I was like, oh shit.
All right, no worries. Okay. So I'm catching up on comments. Let me catch up, and then we'll get back into our conversation. So Blade, always heard semiconductors were cyclical stocks. Either semis are in a prolonged bull cycle, or industry has bucked the cyclical narrative. yeah, good observation. And semis are cyclical. They are. So on AI, I'd like to respond to this really quick. So I think AI, like social, is going to be specific to a country. For example, in China, you can't run the same Facebook app that we run here. There's a different Facebook app because they get to tell Facebook, this is what you can and cannot do. And I think the same thing's going to happen with AI. AI is going to be like the AI you can use in the US is going to be different than the AI you would use in Germany, which is going to be different than the one you can use in Korea, and so forth and so on. And I think some governments are going to be careful with it, especially around threats to employment, because I think it's underestimated how threatening it is to people. Like you guys remember that Twilight Zone episode where the robots and machines took over, and it finally took over the main kind of like duty manager's job, and another robot came out. I think that's the fear of people, that AI is going to replace all the employees, and then what are employees going to do? So I think they're going to really put pressure on governments to have some type of oversight, and that's what I'm saying. But good comment there. So while you were talking earlier, Scott, and you showed the general kind of PE ratios, I looked up, and this is from Google's Gemini AI app. The P ratio for semiconductor industry in 2024 is 54.55. That's the whole industry. So again, I would think that's expensive in my book. Wanted to show that. Okay. And my comment was too long, so it kind of bled over to another one. All right, good stuff. So getting back to a couple other topics. So there's a couple of stocks that I sold this week. One of them was Panel. It's a really neat little shipping company, but I'd owned it for a number of years, and I owned Panel and at PANL. And then the other company I own is Zim, and Zim's been really doing well, to the point where, you know what, it was too much in my portfolio, and I am accumulating cash. I'm not hoarding cash. Most of my capital is invested in a stock, primarily stocks, bonds, cryptocurrencies. But I am comfortable growing my cash because as mentioned, I do believe we're going to have times of better prices on stocks. And I am beginning to expand into short selling as well as options, because if I believe it's a very expensive market, searching for the next discounted company becomes harder, but searching for the next overpriced company becomes easier. It's like, whoa. So I've accumulated cash for those reasons. And the other company that I sold was, I already forgot, so I'll have to look it up. So a couple companies that I sold, I've been growing my cash base, and for that expectation, I did start a short position on NVIDIA. I'm willing to take any questions that are out there, but you can see the video. I have, my complete reasons for it. And I did communicate with Scott over email, and I appreciate you responding. He didn't tell me to do it, but I decided to start it on Wednesday. On Wednesday, the stock went up. I think it was announced that they're going to do a stock split. Is that right?
Yeah.
And they're going to do a 10-for-1. And for some reason, the stock just took off. And I'm like, that's just nuts. Stock split doesn't add value. It just makes it so that the math is different. So that was just one more reason among a giant pile of reasons why I thought NVIDIA was overpriced. So I'm like, I'm going to start a short position. I'm not going to bet the farm. It's going to be manageable. I'm going to put some safeguards. If it goes up 30%, I will sell and take a loss, and my ego will be bruised, but I'll probably learn something, and I'll try to understand, something and learn from it. If it goes down 30%, I will sell, and I might act in between those 2 points. But since then, I've done okay. I sold, I bought it at 11.40. It was like trading at 11.41 and some change. And I think I've got a 4% cushion at this point. We'll see if it keeps going down. I'm going to track it, obviously, ongoing, and we'll see where it goes. So that was another position I took. Some of the stocks that I'm continuing to buy are Comcast, Nike. Let me share this. Comcast, because I think it's undervalued and it was sold off. So I'm buying Nike, Starbucks, Prudential, Catalyst Pharma. Now I remember the other company I sold. So Harmony Biotechnology I sold because I had a kind of a collage of small biotech companies because I thought they were really discounted. And I feel like I kept the two best ones, which is Catalyst and United Therapeutics. And then I have Big Pharma and Pfizer. And I have Intel, which is a beaten up stock in semiconductor. And I plan to sell my Qualcomm stock this week. I bought it. I did really well with it. Short term, it's up quite a bit. And if I believe that semiconductor is overly priced, I'm going to sell it this week. And that's it. So that's what I'm doing this week. All right. A couple comments, and I'll turn it back over to you, Scott. So cinematographers, personally, I would enter Etsy approximately at $73. Confirm recovery off historical support lows since. Awesome. Hey, I see that this is you're using some technical trading terms here, and I'm not a technical trader. I think my 19-year-old son is, and he at times gives me a lesson. If anybody would like to do a live stream with me and cover technical trading, I would be very interested in that. But any comments you would have on this, Scott, on this comment?
No, he's just saying 38 was the low. I think they because I don't like to look at historical stock prices. I know to figure out if I'm going to invest or not. I think most people, that's how they invest. They look at a stock and they say, wow, it was trading at $500. Now it's $50. Therefore, I'm buying it. And the funny thing is that people have done that and said, and I said, but it wasn't trading at $500. It's because it's the reverse stock splits. It appears $500, but if you were trading it back in the year 2000, where the chart says $500, you would see it was not even close to $500, probably $5. But people don't understand that sometimes. Reverse stock splits. But I think resistance points makes sense, even for a long-term trader like me, because I do feel good if I see a stock was trading at like $200 and now it's at 50, and I still feel the fundamentals are there, because most stocks go up a lot before they make money. I'm sure you guys know this with like Amazon, Tesla. They go way up. It gets very expensive. The market cap gets 100 billion, 200 billion, 300 billion before they even sometimes have that much revenue, because of market perception. The market feels the future of the company is so strong, and in Amazon's case, it was, and it grew into its market cap and then flourished. Tesla regressed. It was cut in half. It was over 1 trillion. Now it's what, $500 billion? So it never hit those levels. But that's the thing. People force a stock price way higher before the fundamentals are there. So you have to just overpay for a stock if you want to get into it. But it's tough unless you're really good at stock picking and you identify a stock before it's the run up, which is
in the short term, stocks are a popularity contest. In the long term, they're a weighing machine where they weigh fundamentals, they weigh free cash flows. And I totally see that it's not my type of investing, but like Jim Cramer is a momentum investor. He sees a particular space and he's going to push a stock and see the momentum go up, and he will trade on that. All right. It seems that he recommends that you trade on that. That's not the trading that I do. That's not the investing that I do. I'd rather know that, hey, this is going to be worth a lot more in 5 years, as opposed to this is what's popular today.
Yes, but it's nothing, because this is how you learn. Like, if I don't put anything into Etsy, I'm probably not going to follow it. But if I wanted to get into it, and so yeah, you have to get a little skin in the game. I don't see anything wrong.
The other thing too that I could totally see is Etsy gets acquired. I've had 3 or 4 companies. I owned Activision. I owned a software company. I've owned like 3 or 4 stocks in the last 4 or 5 years that were acquired. And Activision was a nice one. It was like a 60% premium on the stock price. So I've had these stocks. Etsy, I think, is like, if you're sitting there and you're like Amazon or Walmart, right? You're like, this is a tiny market cap, man. We can increase our sales by almost 3 billion, and they have great cash flow. They're just going to be an addition. So this would be totally an acquisition target in my mind.
No, I'm sure people have asked him. I'm sure.
Yeah.
Yeah, and that's one thing I talked about on my channel in the past. How to identify acquisition targets, because this and the best companies to acquire are companies that are making money. Like, this is an example of companies making money, positive free cash flow, a good amount of free cash flow, consistent, and it's not overvalued at this point. But when are they going to get acquired? That's a hard part. And but the great thing is the stock goes up like 50% as soon as the acquisition is announced.
And it seems to me that acquisitions, like mergers, the volume's gone down quite a bit. It's like before COVID, and I guess a little after COVID, acquisitions were happening. Like Microsoft acquired Activision. There were some acquisitions that happened, but I haven't seen a whole lot recently. Have you?
Yeah, I guess I haven't noticed it as much. So maybe you're right. I didn't even think about it. Yeah, but that's the name of the game. That's how these companies, they just gobble up smaller companies. I guess if it's a real small acquisition, like if a company buys a private company, it's not in the news. Probably every month, Google and Amazon acquire 10 companies. Like, they're just always acquiring these little companies to improve their a lot of things, to improve their technology, to improve their products. But there's nothing wrong as long as you keep a bulk of your money in stuff that's safe. I have like 20% of my money in S&P 500, but I don't mind throwing around 1 or 2% in an Etsy and an Accelera, and I've taken some hits, but that's how you learn.
Yeah, and I think there's a question: would you allocate 10%? And I think how I would answer that is, I'm not going to put a number out there like 10% or 5% or 20%. I would just say that you put a numeric amount. In my mind, for me, it's an amount that just is, if everything goes wrong, I can't take my wife to Europe this year. Okay. Because I'll feel like I'm a saver. I'm frugal minded. And that's the extent of it. That's the worst case scenario is, sorry, honey, we can't go to Europe for 3-4 weeks this year. All right. And I'll have to, be careful with my spend that year. That's the worst case scenario. And it probably wouldn't even affect me to that level. That's how I would answer the question, is make it so that, and I would also say that I really like doing it because I need to exercise the execution of my logic and my analysis. If I really believe my analysis, like I thought Tesla was overpriced, you can watch my videos on my channel. They're time stamped. I said Tesla was overpriced when it was near its high, It's now way lower. Well, if you cannot exercise on your own analysis, you're not going to learn. Like you said, you're buying Etsy, right? Well, I'm sure now everything's real. Your analysis are real, gains are real, losses are real. And I like a piece of my portfolio where if I learn something, like buying meta stock when everything was terrible, I learned two things. A, you got to completely abandon emotional feelings during those periods. You need to think very mathematically, logically, and just say, if meta goes down, so's everybody. And so I'm buying meta stock. This is the best horse to ride going forward. And as well as Alphabet. I was buying Alphabet, big time. So I was able to exercise those things with that kind of risk section of the portfolio. And really, it wasn't all that risky. And I think that that's a good habit, which is, don't play with your whole portfolio. And, it's the term that the Wall Street bets say, you only live once, YOLO. Nah, that's right. I only live once, so I don't want to waste my money. I don't want to lose all my money, and I want to have fun at the same time. So I will take a percentage that isn't going to be material to my portfolio and really take those chances where it gives me an opportunity to learn. It gives me an opportunity to succeed. I'm not planning on losing every investment. I make investments that I think I can win. I lose some of them, but in the most of the time, they work out the way I thought. And sometimes they surprise me.
Yeah.
All right. So, hello. What about GE? So, GE has kind of split up into a couple pieces, right?
Yeah.
And I know you covered GE recently, but you covered the aerospace piece, right?
Yeah, they split up to three companies. They have the Vernova, Aerospace, and Healthcare, and they're all trading under separate tickers. If you want
to, so you said Vernova, Aerospace, and what was the third?
Yeah, let me share. I think it's pretty clear on Investopedia, and if you guys want to, I learned most of my knowledge from Investopedia. It's so user friendly. It's so easy to well, mostly when I was reading through financials, every time I had a stumbling block, I would go to Investopedia and they explained it really well. So yeah, GE splits into three public companies. Here are the three: Vernova, Aerospace, and Healthcare. So GEV, Vernova, that's a ticker. I'll show you. I did a video on GE, which is the aerospace company, and the video I did was I always talk about go through the financial statements, and I talked about the first quarter financials, which included Vernova, because on April 1st they split Vernova into its own company, GEV. So like if you look at the stock price, you see the very first day it started trading was on April 2nd, because that's when it became its own independent company. So GEV, the big GE is the aerospace division. Well, that's 180 billion. Yeah. So Vernova is 48 billion. The aerospace division, and that's their biggest one, 180 billion. And that has the history. See, the stock goes back to the.
Hey, Scott, you still there? I can't hear Scott. Can you guys hear me?
Okay, I'm back. I don't know what.
There you are. I can hear you now.
Yep. Yeah. So when you look at a company, look at a ticker, and look at their financials, you have to remember in this particular situation, it was a different company in the 60s, 70s, even into 2000s, because now they split their companies up. So the ticker GE is just their aerospace division as of April 2nd of this year. Before that, it was the whole GE company. Did you see when I showed you the GEV ticker? Or
yeah.
Okay.
I got that. I think we only lost you for like 2 to 4 seconds. So
okay.
I think you're good.
And then then GE Healthcare. Wait, is that this? I'm not sure if that's the same company. Yeah, that is. Okay, so GEHC, that's been trading since December 2022. So why do companies split apart? I mean, if you think about it from a business perspective, like say me and Victor went into business together. I don't know if I can think of a good example. Say we both had a laundromat. We lived in the same town, and we opened a laundromat together. And people came in to clean their clothes, and we had a good business. But then Victor started doing something personalized to add value to the company. Say he sold, I don't know, he sold something different. So some companies are better off splitting apart, because if he was making a lot of money with his side gig, like selling some product in our laundromat, he could like open a store.
For example, like eBay split off PayPal, and PayPal ended up becoming really big.
Yeah. So you might think, like, why do you split companies apart? Just keep them together. Sometimes it's just easier and to focus on that particular part of the business rather than share. Because when you have one CEO, that CEO controls the entire company. So he might not be that familiar with, for instance, healthcare. He might be a brilliant about like airline, like jets and planes and whatever products they sell in the aerospace division. That might be his forte, but healthcare, he has no idea. So it would be good to have everybody in the company on the same level. So there is some benefits to splitting apart. There is some setbacks too, because when you split apart, if the big moneymaker was aerospace and the GE Healthcare division, now they have their own company and they may be short on funds, for instance, because maybe they're not making as much money. So there's pros and cons.
But I agree with, split ups tend to unlock value. And, I think this one's kind of early, but if you see other split ups, they really did create value. Sometimes, like in the case of eBay, PayPal ended up being more valuable than eBay. And you can point to other examples where, the company that was spun off was kind of left to kind of grow as fast as they could. And they had a CEO, like you said, that could really just focus on, hey, this is the market we're going to go after. We're not going to go after 5 different things as a company. So I think they tend to work. So good stuff. So I think we owe one of the viewers an analysis of VST. Can we jump to VST either on your monitor or I can show it?
Yeah, you could do it.
Sure. So VST, I'm not familiar with the symbol. I am. Vistra. Okay. So Vistra. And I'm showing. Okay. Vistra Corp, together with its subsidiaries, operates an integrated retail electricity and power generation company. The company operates through 6 segments: retail Texas. Threw me off. They have a segment called Texas East, West. I don't think that's correct. So it's a power generating company, which power has been really hot. up 315% over 1 year. Wow. So this is like a pretty hot stock. Utilities, for some reason, look at this. Utilities tend to pay a very high dividend, but this stock's up so much, the dividend's really low. So, these guys have been around since 1882. That's impressive. And if we look at, so a $34 billion market cap.
Oh, wait. Let me just show you something on my screen. I got to show you. 1 second. Sorry. They're a 34 billion market cap, right?
Mm-hmm.
I did a video on them. Wait, can you? I don't see my screen.
Oh, sorry. It's on my bad. There you go.
Look, I did a video in 2021. They were trading at $17, and look at my almost exactly.
Why wasn't I paying attention on that day, Scott?
And just yesterday, the same thing happened. Somebody brought up a ticker I did in 2020, and I was only 4 cents off. Come on, guys, you got to give me a little credit. That's pretty good. They were trading at 8 billion market cap in 2021. I did a video, 35 billion.
Nailed it.
Okay. That makes me happy. But okay, you can go back to your.
So now that you dropped the mic, let's get back to looking at these fundamentals. Great job on that.
Thanks.
I'm going to listen twice as hard now to every one of your videos. Good job on that. So the cash flow, I was looking at it. Free cash flow has really increased. This is a quarterly, and they were operating with a certain price level or free cash flow level, and it's really increased. So that might have something to do with their increased valuation. Now, the story, and I haven't looked into it closely enough, but I think there's a big expectation of the power consumption by data centers is really going to go up. And frankly, the EV market, right? We keep putting more cars into service that are electric. And what's that demand going to do to the power consumption? So I get that more units of power are being sold. Now their revenue is growing, which looks really good. Really nice growth for a utility to grow this rate. That's very good. Overall, I don't like utilities. I've never liked them. I just think that there's too much capital going back into the business. Capital expenses, as you can see here, you got to put a lot of capital back into your business. They're having a very good free cash flow year. I'll give them that much. But if the power, I guess, the revenues kind of flatline and inflation kind of hits their capital expense, that would be a concern that I would have. But overall, I mean, I don't buy utilities, but everybody that did buy utilities, I guess about a year ago, is sitting pretty. So congratulations if you bought this stock. It is really priced up. I mean, you're paying $35 billion for a company that has gone up 300% in the last year. We should have all listened to Scott.
I wish I listened to myself.
Yeah. So that's a very interesting company. Incredible how these utilities have really just gone up in value. Analysts are saying that it's overpriced. It may have been kind of overly bought. It's hard to argue that, but I think a lot of this value is going to stick around because it's not that power consumption is going to go down. It's going to continue to go up. So interesting stock. Thanks for bringing it up. Next one is Meta. All right.
Meta.
Meta is having, I think what's good about having Tesla in the universe is that it kind of takes so much attention that these other companies are doing great, but they're just not they're not put under the magnifying glass. They're kind of let to operate. In the last 5 years, this is what it's done. You know, this is what a value investor should really look at. Stocks will trade up and down, and they offer certain periods of time when it's a great investment. The Facebook business did not change. Facebook in 2021 was just growing by leaps and bounds, global, all that good stuff. Facebook in 2022 was bigger. It created more revenues. It kept expanding, yet the stock sold off like more than 80%. So that was a great opportunity for value investors to jump in. And now they have a dividend. Now it's a dividend stock. So that's great.
Yeah.
A whopping 21%. Woo-hoo.
It's I mean, I don't think Meta is a safe stock. If you want like a truly safe stock, there's like stocks like, I think Costco is much safer. But I think that there's so much the upside potential. I mean, I do feel it's fairly safe, but obviously you saw the volatility. It went down 70% when there was even like some bad news at all about the company. But I didn't sell. I was down 70% on my investment. And then I was down 30%. I invested like in 2017. I was down like 30% on that. But I didn't sell. Thank God I didn't sell. It worked out. You just have to understand that if you want safety, you go to money market or.
Yeah. And I view it as, it's all about, what's the probability, right? And do I believe Facebook, Meta, Instagram, WhatsApp is going to exist in 10 years? Absolutely. Do I think it's going to be bigger? Probably. Do I think it's replaceable? No. There's like billions of people using WhatsApp like every hour of the day. They have people logging into Facebook and Instagram every day. There's businesses on their marketplace. So to me, this is a business that's irreplaceable. And I'm not going to say that they're going to be around in 30 years. I'm not that good. And I'm not going to project that far. But the next 5 years, solid. The next 10 years, they're going to be around. The metaverse is like their failure, and they kind of learned and adapted. AI, this morning, I got my wife was getting them. Meta's got AI, and they're presenting it to users. So my wife started using their AI, and she's not a big technologist. So she started using it. She was using it. And then I got an invitation. So I said, hey, all right, cool. Let's take this thing for a spin. And I asked, hey, Meta AI, how is the U.S. economy performing in 2024? And it had a very good answer. It said the U.S. economy has had mixed performance in 2024 with some key trends and statistics included. It referenced 4 items that it gave me links to, but it had a very organized response. It was pretty impressive. So back to AI. AI is like, wow, going to be big. And Meta has got a front row seat to participate in that industry. So not only are they going to have billions of users, active users, they're going to be able to say, hey, we got this really cool AI app that we can now present to all these billions of users. Huge advantage compared to Microsoft. Huge advantage compared to Alphabet. It's a really interesting concept. I think the stock is discounted by 40% if I look at their earnings per share and, more importantly, their free cash flows. I'm not buying more Meta stock, and the reason for it is it's my biggest position. And if I buy more, I just feel like, man, if Meta does get hit by an asteroid, I'm going to lose like, I don't know what percentage of my portfolio it is, but it's a big amount. And at this point, I'm okay with it being the biggest, stock in my portfolio. It got there because it's done so well. I'm not going to sell any shares, and that's my feeling on Meta. Good question. Awesome stock. Anything else on Meta?
I think I've been saying this for a couple of years. If you want something with great upside. I think Berkshire still, even though it's trading at its all-time high by a lot, they have so much cash, like an unreal amount of cash, and you don't realize
$160 billion.
What's that?
$160 billion.
Yeah, and I think it got close to 200 when they had the meeting, or right after the meeting, because they sold Apple or something. But that's such an advantage, because when stocks crash, people like, that's a great discount. But I don't have any money because all my stocks crashed. I don't have like money to invest in the crash, unless I make, from my job and things like that, or if I happen to have money in some other account. But he has such a benefit that if markets crash, he can pick up things at such a huge discount. So I hope a year ago people listened to me, because it's up over 100%.
Well, I already learned my lesson on GST. I'm going to listen to everything you say from this point forward. And I think Anderson's, I'm sorry I'm late on the comments. He said, applause, take a bow on your GST video. Good job. And then we got more comments. All right. And I'm not sure. See, where are we at here? Yeah, I guess Meta. So I think Meta, again, it's not a matter of, if I owned, let's say, half of what I own in Meta, I'd be buying Meta. I'd be buying Meta at every pullback, every down day. And let's talk about that for a second. There's endless number of ways of how you can buy into a stock. Now, I happen to believe that, or I happen to feel comfortable with, I can't tell you where the bottom's going to be reached in a stock, right? It could be here. It could be here. I think you talked about that at Netflix. It could be here. It could be here. I'm not that good. But I am wise enough to know when a stock is really discounted. And I start buying, and I buy each week. And I buy in logical, bundles of shares, especially on down days. And down days, I buy more. And then I build up a position in a stock during a period where I feel it's discounted. That way I'm not under the pressure, nor I might benefit or just average in my price in a zone that I feel it's discounted. That's my approach. How do you invest, Scott? Let's say the next Meta, it might be Etsy, it may not, but how would you buy into that stock? Is it one time, hey, here's X amount, or is it, hey, I'm going to invest in it over time?
In a Meta, or in just any stock?
Brand new stock. This is, ABC company. They're growing at 30% a year. They just broke free cash flow. You're excited about it because nobody's heard of ABC company, or not a lot of investors have heard. You really believe in this company. How would you buy into that company? Would you buy it all at once, or would you average in your purchases?
Usually, I buy all at once. I usually don't split it up. And I know people I argue it's better if you dollar cost average, things like that. I usually do a one time. Most of my majority of my investments are a one time thing. I usually don't average down, and I probably there are some things, some stocks, like sometimes I'll go a year, like the past year, anytime I had dividends every month, I would put it into Microsoft. So I just been adding to my Microsoft, and then sometimes I pick a stock or the S&P index. But I guess but majority of the time it's just a one time thing, But after Meta crash and come up, I'm gonna start thinking about doing that strategy. I probably could have been better off if I bought it when it came down.
Yeah. I mean, it's when I was first investing, I kind of, there was a reason for it is, 30% 30 years ago, I think each trade was like $30. So,
right, yeah.
So you're like, well, if I were to buy a few shares each week, I'm paying $30 each time. The transaction cost.
Yeah.
I didn't have that much money back then, so it might be $1,000, might be $2,000. Well, $30 in $1,000, that's a 3%. I'm giving up 3% out of the gate. Boom, that money just vaporized. So it was more of a mentality of, okay, let me think about it and wait for the stock to be at the right place and then buy it, right? And that was, I think it was limiting. Then we get to the modern era where, trades, thanks to E-Trade, they went down to like $7.95 or $6.95, I forget. So that really reduced, trading costs. Okay, that's better. And then when we got Robinhood in the game, it was like, zero cost trades. Awesome. So it's really opened up the possibility of, hey, you want to buy $25 in a stock? Go for it. You want to buy $25,000 in a stock? Go for it. There's no transaction cost. There's no penalty in buying a very small bundle of a particular stock. Having said that, my behavior did evolve because early on it was just so expensive to trade. But now it's super easy. You can do it anytime that market's open. And that's kind of evolved for me.
Yeah, right. True. That makes a good point. Are we talking about options? Did you want to do that, or?
I do. Let me make sure I've got all
we don't have to,
covered. Yeah. I'd like to. Give me a second. I just want to make sure there isn't somebody who asked a question and I missed it, which can happen. Okay. All right. Let's talk about options. So this is the site you referred to earlier, right? Investopedia? Yeah. So I want to talk about options, and I know that you brought it up on some of your live streams, and I listened. And I wanted to just we don't have to go over everything because I think we can spend 20 live streams talking about options, but maybe just kind of setting the table on what are the different types of options that are out there. Which ones would you be buying if you were optimistic, a bull on a stock? Which ones would you be buying if you were a bear or pessimistic on a stock? Which ones would be where? So I'll let you kind of lead the conversation piece on the types of options.
Can't really. Well, yeah. So these are the 4 basic options. You can get much more complex with straddles and like all these weird names. So if you're long a stock, long means you think it's going to go up. You can buy the stock, which is how most of us do it, or you can buy go back. So you could buy a call. That's another way to long a stock. You're using leverage. There's timing in it too, because you might not. It has to be within a certain time. So when you buy a call option, you're buying the right to buy that stock at a certain price by a certain date.
So it'd be, let's say, going back to Meta, right? You're like, I really like Meta and I want to buy it if it goes up 5%, but I don't want to buy it right now because the stock market may crash. So I'm going to go ahead and buy some calls. And if the price hits 5% higher, then I have access to those shares. Is that right?
Yeah. So there's much more volatility involved. You could make millions on options with only investing like $10,000. Where to make millions on a stock, you probably have to put millions into the stock, unless you happen to pick NVIDIA.
So just following your logic there, if we were sitting on NVIDIA, not too long ago, let's say in January, and you're like, I'm going to buy, because in January we were at $481 per share. So I'm going to buy some call options for 6 months later. I'm going to buy them for, like you said, 10 grand, but then I'm going to control a certain number of shares. And in that time, NVIDIA more than doubled, that's where you're talking about big return. Is that right?
Yeah. So you probably could have made a pretty penny with NVIDIA, but not as much as if you bought NVIDIA, because the price changes a lot. That's why the guy, Roaring Kitty, made so much with GameStop, because nobody else was buying the options. So
Right.
he got it for such a cheap price. But it was pretty well known, NVIDIA. You still could have had a good return, but you couldn't have made like $50 million on 50,000 like he did with GameStop. You could have tripled your money or quadrupled your money.
But if you went super micro computer and you said, hey, I believe in this company, and you're like, it's beginning of the year.
Yeah, you probably could have gotten much better odds on. You could have levered a lot more.
Yeah.
You could have turned 10,000.
Got it. So yeah, on some of these, unknown names, the options are going to be less expensive because the retail investor is like, hey, I don't know super micro computer did not exist in my life, in my universe, a year and a half ago. Now they do. It's like, oh, interesting. So very good. So that's the first option. That's when you're bullish on a company and you want to really leverage potentially upward momentum in a stock. Okay. Let's go after the second one. So now you're going to sell a call.
So this, if you're bullish, you can buy a call or sell a put. That's bullish. If you're bearish, you could do the middle two. You could sell a call or buy a put. It's using leverage. So it has to go up quite a bit or down quite a bit in order to make money. If you buy like a stock that doubles, but it takes 2 years to double, and it doubles a little bit over 2 years, you can't make really much money in options. However, you could make a lot on options if a stock is flat. That's because a lot of times you don't make money when the stock is flat. Like you buy a stock and it doesn't move for 10 years. But with options, you can collect premiums if you sell a call option.
Right.
But that's how I used to get into options. I would sell calls on stocks I owned. You don't want to sell calls on stocks you do not own. It's called a naked call, and your loss can be infinite. That's the most.
What you're saying in a call is you're saying, and I'm not going to use one of these extreme examples. I'm just going to use an average example. Let's say AbbVie, right? So with AbbVie, you're saying, I think AbbVie, the business is going to go down. I'm going to sell a call, and I'm willing to sell you this stock if it goes up 10%. And you're expecting it's not going to go up 10%. I'm just going to keep the premiums, and then you're going to have nothing because the stock doesn't go up, and I have your premiums at the end of the term. Now, if AbbVie all of a sudden says, hey, we have a new weight loss drug and it's better than all of them, and the stock doubles, you're on the hook for buying those shares and delivering those shares at the agreed to price.
Yeah, if you shouldn't sell calls unless you own a stock, because if you own the stock, then you just get your shares taken away. They just take it out of your account. They don't ask you.
So it's kind of like, hey, was money you did lose, just for the record, because now if, let's say AbbVie was trading at $320 a share, you're like, oh, I sold them at a 5% premium above 161, and now those shares have been taken away from me. It does hurt. But you're not sitting there going, oh, great. Now I have to buy, I don't know, 10 shares, 100 shares at $320 a share and deliver.
The minimum is 100. The minimum is 100. One option contract is 100 shares.
I have to buy $320,000 of stock and deliver it to somebody.
It could be painful. If you sell one call option, it's 100 shares. If you sell 5 call options, it's 500 shares. So you can see how it leverages up pretty quickly.
And my numbers are wrong. It'd be $32,000.
Yeah.
So, okay. So we covered the first two. Very good. And then, okay, buy a put. Take us through the mechanics there.
So this is the safest way. If you're really, really bearish, like Victor is on NVIDIA, he sold short. So I said to him, I'd be much more comfortable buying a put, because buying a put, you're kind of, it's kind of cap your losses, because you're buying the right to sell the stock at a certain price. So if NVIDIA is, what is it, 1,200? It's 1,200.
No, it's a little under 1,100.
Okay, so it's 1,100 NVIDIA, and then what Victor did was say it goes to 1,000. So now Victor lost $100 if he sold one stock short. He gained $100. He made $100. If it went to 1,200, he lost $100. Where if I have a put, like, so if in theory, if it goes to like 2,000, he would get screwed. He would lose $1,000. And if he did, I don't know how many shares he did. If he did 10 shares, he would lose $10,000. So some people lose their life savings on stuff like this because they get crazy and they sell a ton short. They sold, I've heard of that, like selling Tesla short, and it goes from 50 to 500, and a person files bankruptcy because they did 100 shares. But the good thing about options is that I just have to pay a premium.
So when you sell a put, you're saying that I get to sell this stock, let's say at 1,095.
When you buy a put, not sell a put.
Okay. When I buy a put, I say I have the right to sell NVIDIA at 1,095, and I have to buy 100 shares, right?
Well, I have to pick the price. So I'm probably gonna, I'll go to like 900 or something. It depends on what. It's different prices depending on what dollar amount. So I have the right to sell it for 900.
Let's keep it simple. Let's say 1,000, right?
Okay, yeah, so 1,000.
Pick 1,000, and if the price does drop below 1,000, I'm in the money, and I made money because the option is not going to be 1,095. It's going to be a fraction of that. I don't know what it would be, but it would be a fraction of that. And potentially I might make $100 a share or $200 a share, but it's very leveraged because I didn't have to buy the shares. Okay. So that's what you're trying to do there with that option.
Yeah.
Now, if NVIDIA goes up, those options are worthless.
Then I just don't exercise. But if it goes to 500, I have the ability to sell the shares for 900, even though it went to 500.
Correct.
And then if I did 5 options, I could do 500 shares, selling them for 900 each.
So looking at NVIDIA, right? If you short the shares, okay, we know what that is I sold short. I'm responsible for returning those shares at whatever price it ends up being when I close out the position. But when you sell a put, your responsibility is for paying for that option, and then you're either going to make some money or you're going to lose your the whole price that you paid for the option, right?
Yeah. So if I'm short, I would buy the put, and then somebody in the open market would sell it to me.
So I have a question. So if you asked, okay, let's say on NVIDIA, and you said, hey, I want to buy a put and I want to buy it for 7 months or whatever the logical time span is available. And let's say after 4 months, you're like, holy smokes, it's dropped to like 700. Do I have the right to exercise it and just go ahead and, exercise?
Anytime. You could exercise anytime. And the value of the option, you could trade the option in the open market too, which is what most people, I've never actually bought shares from an option. I just traded the option because the option has value. That's generally how almost everybody does it, like 99% of the people. So if I did a 7-month contract for Nvidia at $900 and it went to $600 after 2 months, I would just trade the option, which would be pretty much the price of buying the shares and selling them. Because if it went from 900 to 600, that would be a $300 per share. So the option would be worth 300 times, if it was one contract, 300 times 100.
Excellent. Very good job describing that. Let me make sure if there's any questions on.
Is that clear? Because it's hard to explain options, but I think this is the clearest we can do it.
Yeah, it makes sense to me. And I'm not seeing any questions on the comments. So if there's any confusion, everybody, just ask questions in the comments. I see some comments coming in, but they're not related to options. I think we're rounding third, headed for home here. Now let's talk about selling a put.
So this can be risky, but the thing with selling a put, is you don't have infinite loss. Selling a naked call, naked means you don't own the shares. When you sell a naked call, your loss is infinite because the stock could just go up. I mean, it won't go to infinity, but it could theoretically go up a really high amount. But when you sell a put, the stock can't go below zero. In Nvidia's case, that's a long range from 1100 to zero. So if you sell the put and say you sell a $500 put and the company goes bankrupt, which I know wouldn't happen, it goes zero, which would be the greatest thing for the person buying a put, then you'd have to sell the shares. You'd have to
$500 a share.
Even though it's zero, it's worthless. But you have to buy it from somebody
at $500 a share.
Got it. Person,
that's an agreement for you to buy a stock. And like you said, going back to NVIDIA, so it's trading at $11.95. I'm going to show the 5-year chart. Yeah. 5-year chart will get me there. And let's say we had another event like the event of starting in 2021, NVIDIA goes down 66%. You're sitting there going, sweet. And actually it didn't get to 500. Well, actually it did dip below 500. So you're sitting on maybe $100 per share gain. And you would say, great. Or no, you sold that put. So you're like, darn, now I got to deliver shares, or somebody's going to pay me, or I'm going to pay somebody $500 per share, but the shares are only trading for $400. So I'm going to lose $100 per share. Is that right?
Yeah. So if you sell a put, you have to sell the shares at the predetermined price. So in this situation, it looks like you're starting at about 280, right? That was the starting point. So it wouldn't be 500 in this case because it's already 280. So it would be something below 280 would be the contract. So yeah.
So it started at like 280 and it ended up around 70. So
if you did like a 150, if you're selling puts at 150, that means you're selling someone the right to sell you the shares. So you really have to buy the shares at 150, regardless of what the price is, because you collected the premium from the person. So if it goes to 100, you have to come up with the shares and sell it for. You have to buy it for 150.
Okay.
It gets kind of confusing, especially puts. You're buying a put. You're buying the right to sell shares to somebody.
Yep.
What does that say? You have the right to sell a security. You're buying the right to sell shares. When you sell a put, you're selling the right to buy the security. It's kind of like backwards of a call. And I sometimes trip over it myself, trying to explain it, but yeah.
Yeah. So, and you pointed to why I don't trade options is investing is already hard enough. It's really hard. If I can find the right companies to invest in and not invest in, I'm in a good place. And especially with money, earning 5 to 8% right now, cash. All right. So when I went through my thought process on selling NVIDIA short, I put a 30% limit there. If it goes up 30%, I take the medicine and I close it out, and I lost 30%. Done. And if it goes down 30%, I sell it, and my logic was accurate. I thought that the market was really expensive. The semiconductor space is way overheated. Okay, good. And either one. And I completely understand that logic. You don't have to teach me that. I could do that. I could do that right now. And I did it. So that's why I went with a short sale versus options, is because options, it's like, okay, I got to twist my mind to kind of get there, and it's not intuitive. I'd rather just leave it simple and intuitive. And I have control of that short on NVIDIA. Again, if it gets to 30% either way, it's either a winner or a loser. If it stays in between the two, I may close it out, just because if I find that it's taking too much of my time, that in itself is too expensive. If
you're paying margin, even if it's flat.
No, that's one thing that was surprising is my broker, I said, okay, so I'm going to be paying interest. And he said, no, that's a misconception. If you have the cash, you're fine. You're going to buy on margin, but if you have the cash, then you're not going to pay any interest.
Oh, well, then there's no loss, really. Well, I guess.
Back to my cash position, I've been building up cash, and it happened to be a asset in this case here, because I was expecting, okay, I'm going to have to pay an interest rate on this short. And he said, no, that's a misconception. If you didn't have the cash and you did buy on margin and you needed to buy it on margin, yes, you would. But since you have all that cash, you're good.
There you go. So cash can be beneficial. But sometimes it's just better to do what you did, because then you don't have to worry about timing it.
Yeah. And again, I'll remind everybody watching, right, is we don't recommend you buy any stock that we talked about. We don't recommend you sell any stock we talked about. We don't recommend you buy or sell options. We don't recommend you short stocks. It's never any recommendation. It's just what I'm doing, what Scott's doing, never financial advice. Keep going, Scott.
Yeah. So we didn't get many questions on options.
Well, we have more. So I know I thought it was a good piece, and I'm being selfish. I wanted to know more. All right.
Yeah.
All right. So would you buy Square or PayPal for the next 5 years? You're on the hot seat, Scott. Which one's it going to be?
It's I probably wouldn't buy either, but I do like Venmo. So that's the only reason I like PayPal, because I think Venmo is a good and I've always used PayPal. It is the reason I don't like either, and I think it's a great business. That's why you make a lot of profit, high margin business. It just feels too competitive. You have like banks that can do the same thing, or credit card companies that can do the same thing. So it's just like and those companies have been around a long time. But I guess if I had to pick, like I would just pick PayPal.
You have to pick one or the other. If you pick none of the above, you don't get either share. It's a free share, but you have to pick one or the other.
Yeah. So I would pick PayPal because I use it all the time, and I like Venmo. I don't think PayPal. I think they're kind of losing customer base, but Venmo is their kind of leader. So yeah, that's why I pick it.
All right. So my answer is PayPal. I'm buying PayPal. I own PayPal. I think PayPal is misunderstood, and I have a video on my channel if you want to see more of my reasons. And I think they're growing their revenue, their top line, and that's important. They are losing a few subscribers, but If you look at the Venmo business, it really hasn't been monetized. And I think at some point it will be monetized. They're probably selling the data like crazy, right? And they're probably making money that we don't know of. They just don't want to tell everybody, hey, we're selling your data, by the way. We could see everything you're doing and we sell it for a lot of money. They don't want to say that. So they're going to keep that private. All right. Can you spare a square? All right.
Seinfeld reference.
Yeah, I hope PayPal steps up. I think, like Meta in 2022, I mean, for Pete's sake, man, it seems like when it's like a dog pile, if you remember that term, when everybody got on Zuckerberg, it was like he was the biggest idiot in technology, just the biggest idiot. And I'm like, you got to be kidding me. This guy who was 18 and he said, hey, I'm going to start Facebook. And voila, here he is. So it's been a lot of brilliant things he's done, and he's made mistakes. He's human. And I think PayPal is unfairly punished. Every mistake they make is like magnified 20. It's almost like the news media already knows, hey, here's our script on how to beat up PayPal. And, will that change? Well, it'll change if PayPal starts delivering. And I thought their earnings were good, but I think if they have continued execution and if they can have like something new and cool, like Venmo's cool, but it's not new. They can have one more cool thing. Maybe that'll kind of get things moving in the right direction from a sentiment perspective. Call options help you buy at a lower price. Put options help you sell at a higher price. Well stated. Thank you, sir. Margin leverage. Nope. Couldn't sleep. I'm with you. I need to know a certain investment is not going to end up being like a massive loss. I tend to be probably like typical investor, right? Is I like to know what's the order of magnitude, what's the total, loss if the worst case scenario happens, and in any investment, that's why real estate right now is, a lot of people are buying, and I'm like, man, I could take you through a model where that would keep me up at night. I have a friend that bought at the wrong time, and he bought a property, and the property dropped like 40-50% in value in the last correction. And it took him like 14 years to break even on a property.
Yeah.
14 years at it. Zero return after 14 years. It's like, that's the penalty in real estate that people don't quite understand, because there's like old sayings that real estate's always a good investment because they're not making any more. No, it's a bad investment sometimes. And I happen to think that real estate's really, really risky right now. So no leverage and no real estate buying right now for me. All right. One vote for Square. All right. Cinematographers. I'm glad you're on, dude, because you had 2 PayPal votes and 1 Square. I think Square is kind of cool, but I look at their financials and I don't like what I see. I like what I see in the PayPal side. Can you take a look at SN? Let's take a look at SN. How you doing on time, Scott?
I'm good. You want to go till noon or?
Yeah, it sounds good. Noon Pacific. So Shark Ninja. I think I've seen the infomercial. Product design and technology company engages in the provision and various solutions for consumers worldwide. I think we've all seen some kind of Ninja product, right? The Blender Ninja or whatever Ninja, right? So that's what they do. It's a $10 billion business. Revenue is $4.4 billion. They are profitable. And analysts say, hey, it's priced fairly. It's a strong buy, but it's priced fairly. Over the last year, it's up 155%. What else would you expect from a Ninja stock? And then over the last 5 years, what's going on here? Why is this? Did it just IPO? Is that the story?
Yeah, it's pretty new. It's pretty new.
Wow. This is one of the few, if not the only IPO that I've ever seen do this. They usually start at a price, drop, and then they rise.
Yeah,
All right.
it's done really well.
So they have their financials, revenue's growing, but although they had a down year in 22, but they're back to growing in 23. Growing revenue.
They're profitable, positive cash flow, a really well-run company. You know, good margins. You really, really nothing bad to say. And I wish, yeah, it's just so hard. Like, I wish I would have seen this when it first came out. Like, it's just so hard to look into every single stock.
I wouldn't have bought it just because I see most IPO prices drop so much. I mean, you can go Airbnb, Coinbase. I mean, I can go down the list of like, what's the one that we saw? Path. Path is just dropped like a stone. Snow. I mean, you look at the IPOs that have come out, they're just big losers for the first year. So I just don't buy IPOs. And I always find it hard to trust their numbers. Or not trust, but I should say their numbers. I mean, they're just kind of beginning to report publicly. And so that said, I wouldn't have invested because it's an IPO stock.
Yeah.
And I usually wait for it to settle down. Even Google, if you look at Alphabet, which used to be called Google. If we look at, I don't know if this is going to show it to me, but if you went way back here, you would see that the stock price opened, it dropped, and then it came back up.
Do Meta, because I bought Meta the very first day they started trading. And people were like, oh my God, you're stupid. And I was down 50% after, you can't look at it. I was down 40% after 2 months. Or not even 1 month.
That's my point is when you see it kind of shows it that way back here, it was way down. Even a quality company at that time was called Facebook, growing. Everybody could see that Facebook is a real thing. IPOs from my observation, they tend to just go down.
Yeah.
So I wait for it to settle down. But if you bought SN, great job. I do think the brand behind this is really strong. As soon as I saw Shark Ninja, I'm like, oh, I know what we're talking about. So the brand value's there. Can they be replaced? Potentially. I don't think it'd be easy. My biggest worry would be that this company puts out a product and it does something harmful to people. And A, there's a class action lawsuit. B, now the brand is, kind of tarnished because it's, hey, they're kind of cool products, but they can cause house fires or they can cause blah, right? So that kind of thing could happen because it's consumer product. And these guys are small, but overall it's been a great winner. And congratulations if you bought it early. A valuation perspective, I probably wouldn't see a big discount because the price is so high and their free cash flow is 148. So I could probably, nope. I would not show you a discount on the stock. I'd probably show it that it's selling at a premium. There's another penalty that I put on stocks like this is if it's easily recognizable to a retail consumer, it's a bad thing because retail investors are like, oh, I know what Shark Ninja is. I'm going to buy the stock without any analysis. And they just buy the stock. And I understand that. Hey, I like my Shark Ninja. I'm going to buy the stock. And okay, but that's kind of at what point, is that going to last and go away? So those are my comments on Shark Ninja. Anything else on Shark Ninja?
No, it looks really good. And I'm kicking myself. I didn't see this earlier, but I guess you can't. Was it Peter Lynch who said the winner is the person who uncovers the most stones or turns over the most stones? So you could only turn over so many stones. You only have so much time to do your due diligence. So there's always going to be these ones that slip through.
So I love Peter Lynch's mentality. And again, I reference him quite a bit. But I'll tell you something he did say that ended up being kind of like he would have lost a lot of money in nowadays. He had a expression which was, don't ever buy something you can't touch. And I think he was before the era of .com, before the era of Meta, Alphabet, and he would totally be like, oh, I could touch the iPhone. I'm going to buy Apple. I could totally touch, this product, but he would have missed on Alphabet, Meta, and a lot, Uber, and because it's something you can't touch. All right. So, just bought Altria, and this one always looks good to me from a fundamental perspective.
Always undervalued. Always.
And I think because it's I'm going to call it a sin stock. So I think some people might be like, oh, I don't want to own a tobacco stock.
This is what you guys do. This is a discount. Look, you could have bought it 2 years ago and paid 20% more, but now you can get a discount. So you have to look at the numbers now to figure out, is a discount because of the fundamentals or because of market panic? But it's a tough one. Any stock in tobacco industry, cannabis industry, gambling industry, they just don't go. There's a cap. They can't go up as much as they should.
Yeah, and so first, this stock always puts out a nice dividend.
Yeah,
it's doing well year to date, and the 1 year looks doesn't look all that great, but it did offer a really low purchase price on the stock, so that's good. And if I look at their cash flow, every time I look at it, I'm like, hey, cash flow is really well. $9 billion of free cash flow on a $79 billion market cap. Very good cash flow. Very good cash flow.
9 times free cash flow. Single digits.
Now, this might be a little bit of a worry, which is they're not growing. So what's happening? Is tobacco use going away and everybody's going to the vaping?
They're dying. They're dying. A lot of people dying that use the products. So they just need to replace those people with younger smokers. So you guys smoke up.
Or they diversify their products, right? Because if they're not smoking tobacco, maybe they're vaping, maybe they're doing other things. And, I'm not going to kind of create products for Altria, but I'm just saying, if one of your product lines is going down, you got to think of other products. Where is it that we can start growing? So this this one always looks like, if you want a good dividend and you could probably get this stock at a certain price, a value investor that just wants a modest return, or this is going to be one of the modest return investments in an income portfolio, totally makes sense. So thanks for the question on that. Good choice. So, all right. Still in the air between Starbucks and Next Era. Any thoughts? So let me get familiar with Next Era. I don't know if you're familiar with Next Era. What's the symbol for Next Era?
I think it's NEE, Next Era Energy.
Yeah, okay. Well, as soon as you say energy, it's like the second most popular term behind AI now.
I know some 32%. People.
Mm-hmm. Okay, that looks good. So these guys distribute subsidiaries, generates, transmits, distributes, sells power. Okay. 2.5% dividend. I'm surprised they're not like flying off the chart. It's actually priced not as high as I thought it would be. 164 billion. Okay. Revenue 27. If we look at cash, so negative last couple of years, not great cash flow, free cash flow. And I think it's because CapEx. This is what always spoils my utility analysis, is the CapEx is so damn high. It's like, geez, you got to rebuy the business every other year.
Yeah.
Yeah. So this one would not cash flow for me. I would not be buying Next Era. What are your thoughts on Nextera versus Starbucks?
Well, I could touch Starbucks. Like you said, I do like Starbucks as an investment. I'm not a big fan of like energy and utilities. And Buffett is, but I generally don't buy. I definitely would buy Starbucks. I think it's a good, really well-run company, dedicated customer base. So I think it's a good long-term play. I see there's volatility though in the short term due to like competition.
Yeah, and I'm going to show you something really quick on one of the main reasons why I don't buy utilities. So let's look at the 5-year return. Near the bottom is our friends in utilities. So 5 years, you make 24% appreciation. And this includes dividends. So
it includes dividends? Really?
That's crazy. Okay, I'm not sure, but I would imagine this return has that. But when you're looking at like healthcare, which has been beaten up and has a 5-year return of 160, I'd rather buy healthcare, I'd rather buy industrials, I'd rather buy, comm services. I think this is understated because Meta and Alphabet are there. Materials. But when you look at this return, you're like, why am I going to park money in utilities? I'd rather be in a bond because I don't have down risk on a bond. But utilities, what if, especially like in California, right? The utility out here for power gets blamed for wildfires and then it takes the company bankrupt. Yay.
Yeah.
All right. So I am a Starbucks buyer. I'm buying into Starbucks. I think it's the number one brand in restaurants, coffee, that specialization, a restaurant coffee. Their business is simple. They make coffee. They make good coffee. I think Starbucks locations tend to be the consumer is comfortable. It's one of the pleasures they have in life. You go there, you have a good cup of coffee, you take a break from the day. So that whole thing, that's Starbucks. As long as the leadership's kind of off to a bad start. Again, I think the media looks for, CEOs to beat up, and like it or not, Starbucks CEO, you've been identified as somebody that's going to be bullied by the media and they're going after them. But I think the underlying business is solid, and I'm going to buy Starbucks stock and I'm going to grow a position. It's the number one play in that category. And I don't buy restaurant stocks. I don't buy Chipotle. I don't buy the restaurant business is just too hard. It's going to maybe have a good year or two and then go down. I'm very bearish on Chipotle. Main reason is when I go into Chipotle, I'm in Southern California. We have awesome Mexican food. When you go to Chipotle, the quality's really gone down, and it's nowhere near it being a good Mexican meal. When I go to McDonald's, it's nowhere near the quality of In-N-Out Burger or some other burger chains that are really delicious. I don't eat at McDonald's. And if I was starving, I'd go to McDonald's. But I don't eat at McDonald's. I don't think for me, my taste buds are accustomed to In-N-Out Burger or something else. I think the Chipotle business is set to really go down. I think their quality levels really decayed, and we'll see what happens. All right. Anyone watch Margin Call? Absolutely. Awesome movie. Did you see Margin Call, Scott?
I think I can't remember it though, but I must have seen it.
I've watched it 3 times. It's good actors, but it's really intense. Where I think it was around the big, the bank failures that were happening, and how an institution was left, in an overnight situation where they didn't have enough liquidity, and it was really, really well done, I thought, and I loved it.
I thought that was called The Big Short.
No, you're thinking of a different movie. We all know The Big Short is The Big Short on the subprime home mortgage market. That one had, Brad Pitt, and they had the whole.
Okay,
Marvel story. That was fun to watch, and I think it was well done as well. If I was going to say, so I think Margin Call was a lower budget, and I think more realistic, and I think that The Big Short was fun to watch, and I love anything. Those actors were great. It was a bigger budget movie, and it was really well done, as well as the newest one being on the whole Roaring Kitty movie. What's it called? I thought it was well done, except
I saw that.
I think the Melvin Capital CEO, it was they got the wrong actor. I love that actor, but the wrong actor was playing the Melvin Capital hedge fund manager. I think it was a little too like trying to be funny.
All right, dumb money.
I thought the Roaring Kitty actor did an awesome job. I thought that it was a fun movie to watch. So, all right, enough of movies. We don't make money watching movies, but they're fun to watch. I hope people really make a lot of money and great choices listening to you guys. Legendary. Awesome. Thanks, Brian. And I hope we all make a ton of money. Would you add CBS at this time? Scott, you're in the
I was thinking about it. Actually, it was between Etsy and CVS, because the whole point of this investment was to grow it 3-4x. And I was like, of course, I don't know what's going to go 3-4x, but I want to take a little risk. I don't want to buy an index, and I don't want to buy like a Microsoft, but what has a chance of going up 3-4x in 2 years? But I know there's probably more of a chance of it possibly even going down. So I thought it was at a low price point, CVS and Etsy. So I picked Etsy, but I think I could see value in CVS. I'm just so concerned about retail. It seems like they're getting slaughtered with theft and stuff like that.
Yeah, I think retail is always tough. I'm buying CVS stock. I think it's undervalued. And CVS has 3 businesses. They have the retail pharmacy business, and I think retail was their pharmacies were suffering losses because there were certain medicines on the shelf that people were going in and stealing. I think they've done something about that. But there's 2 other businesses that always get kind of neglected. Is they're an insurance payer. Insurance payers tend to be like really profitable, cash generating, and they're also a health services provider. Now, we talked about companies that try to do too many things, and kind of when they split up, there's value unlocked. But in the CVS case, it's not like they're doing something completely foreign to them. They're actually trying to keep more of that wallet of that customer. Hey, we come in to see our doctor in our health center in store. It's convenient. You go in store health center. They say, hey, your ear infection, you're going to need some antibiotics. Great. Prescriptions right next to that office in the store. You get your prescription. You pick up a bag of chips and a gallon of milk, and you head home. Oh, and if you want, you can buy their insurance plan, which they have a very well-known insurance brand. So you might even be insured by them. So they get to keep more of your wallet. That totally makes sense to me. Most importantly, they generate great free cash that leads me to believe they're being discounted based on the cash flow forecast that I have for them. Good stuff. So that's why I'm buying CVS, but it's been a down stock. It had a great day Friday. It was up more than 6%. I don't know if you guys noticed that.
No.
I noticed it. All right. Thoughts on Cava? Cava Group. The Cava Group owns and operates a chain of restaurants. So it's kind of dead on arrival for me. What are the brands they offer? So Cava brand operates chain restaurants under Cava brand. They also offer dips, spreads, and dressings in a store. So they're doing restaurants, and then they have I guess some products, in-store products, some food products. So what are their brands here? So this is like on, I guess, food delivery. What is this? Like, I've never heard of this company. Are you familiar with these guys?
No. I mean, I've heard of stock, but I'm not familiar with the companies. They
it seems like it's food delivery here.
They sell like sauces in like stores like Whole Foods. I know that's a lot of they have sales from that. I think they're in a few hundred Whole Foods.
Okay. Oh, so they're in Whole Foods.
That's just one of the things they do. They sell sauces and like, but they do have stores like Zoe's Kitchen or Zoe something. They just acquired them. It's 200.
It's
stores.
healthy food. Looks like salads and healthy food. All right, cool. So we know what they are. $10 billion company. It looks like they're growing. New company, and they've been trading not for too many years. So they've been trading for about a year, and it's good so far. Man, it's 2 IPOs that have gone well, sort of. This one came down a little bit, came down about 42% after it IPO'd. But for the most part, it's been positive. If you bought the IPO price, you're doing really well. So that's good.
Yeah.
So this is a restaurant stock. I tend to avoid restaurant stocks, but what's your feeling on Kava?
I don't know. I don't have too much info on a company.
No free cash flow. They're negative cash flow at this point. So it's all based on sales, and sales, maybe their EPS is positive.
They have a high PE, like a few hundred. I don't know.
Positive earnings per share. So I think it's banking on growth, and it's banking on, hey, we're going to be a little bit like Chipotle, and we're going to grow a lot. We're going to become a brand, and we're going to have more locations. Just restaurants, right? To grow, you got to get more locations, invest capital. You got to sign leases. You got to hire a bunch of people. Okay, that's expensive. You got to pay those people. You got to manage those people, and workman's comp and insurance and all that good stuff. Then you got to buy ingredients that spoil. Oh, wonderful. So if food prices go up, that's your problem. Then you have a finicky consumer, which is, they love your food one day and then they dislike it the next. I used to eat at Chipotle quite often. I thought it was a good alternative, a healthy alternative, but then they disappointed me like 5 times in a row. And I'm like, I'm done with this, man. This is like a high price cafeteria and their food isn't very good. I'm out of here. So I'm not a restaurant investor. Starbucks is a restaurant, but they just do primarily coffee. That's why I invest in Starbucks and coffee. The Starbucks also has a huge food business in store, like grocery stores. You can buy Starbucks, their coffee. The brand's just really strong. So that's my feeling on Kava. And, if you own the stock and have owned the stock for some time, congratulations. It's a real winner. All right. So Brian, thanks, Brian, for joining. NEE 54 to 83 months. Parabolic move. Yep. Yeah, man. It's they're recent. I think a lot of utilities have popped up, and I think there's good reasons for it. But is it really going to be a good business to own? I don't know. I don't own utilities, but I'll let somebody else invest in that. We got another vote for In-N-Out Burger, and for good reason. That's one thing, FYI. I have 2 sons, lovely wife, and myself. I can go to In-N-Out Burger, and everybody eats, and we're all happy, and I pay like $25. How is that possible? And the food's delicious. How's that possible? In-N-Out Burger, I take my hat off to you. You do a great job. All right. Great movie. Breakdown. Victor, nailed it. Yeah. Man, I'm serious about movies. How many times have you seen The Godfather, Scott?
The first one or any of them? Probably like 5, I guess.
Yeah, like the first one, second one are like awesome.
The second, the best one.
I'd say that. And it's usually a pretty good, healthy argument with people.
First and second are really good.
The second one is brilliant. The second one, and that's one of the sequels that was potentially better than the first one, right? So awesome. And
actually, Back to the Future 2, that was the best second, I think.
Gotta agree with you.
It's very rare sequels better than the first. Very rare.
Doc in Back to the Future, man, what a brilliant character they came up with.
Yeah.
I mean, I could watch that dude all day long. All right, Etsy. Here we go. There's a recommendation there. Everybody take a look. You know what? Scott nailed VST. If you didn't learn your lesson on VST, good luck to you. Thanks on Owens Corning. Thoughts on Owens Corning? Okay, I haven't looked at this one in a long time, and I'm more interested in industrials. So, what are your thoughts on Owens Corning? Up 23 year to date, 70% a year. Nice. Dividend is down because the stock's up. 15.6 billion dollar market cap. Revenue is 9.6 billion. This is an industrial, right? Industrial building products and equipment. Now, I can understand that people might be like concerned with housing. You know, spending on housing is really slowed down, so I think that's a concern. But it was go in 21, go in 22. And I think because everybody is investing in their homes.
Yeah, it's a good stock. It's we got to start talking about stocks before they're up 300%. It's hard to do because it's so easy to find these stocks because then everybody talks about it.
One of my opening comments was it's really hard to find discounted stocks. That's
right.
My biggest worry right now is that everybody's up so much and nobody's freaking out about it. And I'm freaking out about it. Like, you know, it's great that Meta's up so much, but it's also like, you know, this isn't going to last forever. So I think that's part of the across the board. Like a lot of these stocks are really expensive. Well, it shouldn't be that way. There should be value out there. I think, you know, like Nike provided a pretty good proposition recently. They were sold off. Our friends at Starbucks, I just talked about CVS, but I don't know if they're going to be like 3-4 baggers. I think they're just going to be good returns. So Owens Corning looks like it's been a good stock to own. It's an industrial. I think it's going to, I would probably end up with a fair value on this stock. We showed up to the party late. It's a little late on this one.
Yeah, but these real estate construction type stocks have just been killing it. Yeah.
Yeah, it was, you know, the home builders surprised me. I owned Lennar and it did okay, but I sold it and then it just flew up. I was like, how did that happen? We're post a pandemic. Nobody wants to sell their house. No, interest rates went from like the interest rate I got on this house, I refinanced 2.5%. Now you're at 7.5%.
2.5.
How's Lennar selling houses? The interest rate tripled. How are they? But they did. And big surprise. All right. Ron, thanks for joining. Yeah, thanks. Enjoy your rest of the day. Enjoy your week. I'm looking forward to stock trading tomorrow. Sometimes I dislike 3-day weekends because I just love to see the market and see what happens. So I'm looking forward to tomorrow. Okay. AMD's Lisa. So I've heard about this. Now we looked at AMD in another live stream we had, I think midweek, and AMD cash flows don't look all that great. And they have a new product, but you know, it's interesting. Like Tesla is a really good example recently. The earnings were terrible. Hey, our revenues are collapsing. We're giving up margin because we have a lot of competition. And then he gets done and he goes, oh, but let me show you a shiny little object over here, which is autonomous driving, which isn't ready to go. And it'll probably be like 5 years before it really gets to market and is ready to go. And investors bought it. And it's like, what? Not me, but some investors bought it. And now the stock's been going down since he announced, autonomous driving. So AMD's Visa, I'm not bought in on it. I think AMD's never been my preferred semiconductor. I've invested in TSM very successfully in Broadcom, Intel, now our friends at Qualcomm. So I'm no stranger to semiconductors, and I've never liked AMD. And I just looked at it this week and did not like what I saw. I'm not informed on Lisa. I'm not going to say it's good or bad. I'm just like, I'm not a big AMD guy. Anything you've seen recently on AMD, Scott?
No, I mean, I just know like it gets a lot of hype. One of the people think their chips are the second to NVIDIA, but I don't really have that much insight into it. Yeah.
The one credit I will give them is they started to compete against NVIDIA for the GPU market back when GPUs were being used for gaming and mining cryptocurrencies. This is like, 4 years ago, maybe 5. And so that investment in time and energy and focus for AMD may come back and be an asset to them. We'll see. So cinematographers used to live in El Segundo. Cool, man. You were in Cali. Thoughts on so we are running out of time, guys. We're not going to look at any more stocks, and I apologize, but we're 12 minutes past, and we can kind of cover these really. So yeah, I appreciate that. On Hymex, it's a stock that I put out recently. Appreciate that, and I apologize that we ran out of time, guys. It was a great live stream. I really appreciate everybody joining. And coal is undervalued industry. Could be. And if you show up and put up these names, put them up early and we'll cover them. Amdu Su. Okay. Yeah. The CEO. Interesting. Okay, good. So we covered a lot of ground today. Scott, thanks so much for joining.
Yeah.
I really appreciate you. And everybody, thanks for joining. We had a lot of attendees, a lot of questions, and we ran out of time. Again, I apologize for that. But overall, everybody enjoy your Sunday afternoon and good luck this week. Let's see what happens and let's tune in again soon. Thanks, everyone.
Okay. See you later. Okay.